If you might be aware, for the government had amended AS 10 on 30th March 2016 by bringing in a notification, which was applicable from 2016-17. When the government brought in this notification, AS 10 was made majoritarily in line with Ind AS 16. So previous AS 10 vis-a-vis Ind AS 16 had more differences, but the amended AS 10, which was applicable from 16-17, had lesser differences as compared to Ind AS 16. So today I will tell you what is the difference between Ind AS 16 compared with the amended AS 10 compared with the old AS 10, because not everybody is updated with the amendments to the AS 10. So we will cover all the differences. Then we have Ind AS 38, which is the intangible assets, which has to be compared with AS 26, intangible assets. And we have Ind AS 40, investment properties, for which there was no comparable standard under Ind AS. There was a minimal guidance under AS 13, investments, but very rare of the companies used to really get the gist of those standards, and there was no detailed guidance under AS 13 also. So these are criteria we'll cover. One more important reason to cover all these three standards together is all the recognition criteria, the main definition of the asset, the measurement criteria are 99% similar for all the three standards. So even when you will study or when you will read it for your application to your real companies, read all these three standards in conjunction with each other, because the basics of the standards are similar. You will have to just classify whether it is a property, plant and equipment, or whether it is an intangible asset, or whether it is an investment property, and apply the respective criteria. So recognition, definition and measurement are similar for all these standards. Now, going ahead with the key definitions for recognition of an asset. As we have studied from our childhood of the accounting, an asset has to be recognized only if the asset is controlled by the entity is expecting certain future economic benefits out of that asset, and the asset is expected to be used for more than 1 year. So only if these three criteria are satisfied, then only you recognize any particular item as asset. So for deciding the criteria, how you should look into a particular transaction is, first of all, whether it is an asset. If it is an asset, only then you move into the further criteria of which category of asset it is, whether it is PP, whether it is intangible asset, whether it is investment property, whether it is certain other financial instrument, but it should be first of all an asset for the company. Now, what do you mean by controlled by the entity? Tell me for an example, today I am a pharma company. I have lots of researchers into my pharma business. These are the employees for my organization. And every time I tell my employees that employees are the assets for the company. On the every appraisal cycle also I tell them that employees are the assets for the company. Does that mean I recognize employees into my balance sheet as an asset? And if no, then why don't I recognize such employees into the balance sheet of the company? The important reason is, even if I might be expecting future economic benefits out of my employees, even if they are expected to stay more than 1 year, but I don't have control over those employees. I cannot tell an employee, or I cannot mandate an employee to stay into my organization for a long period. So that is why such kind of employees are not recognized as assets into the company. This was a very simpler example. But for example, a cricket club has a contract with the individual players to stay with that club for a particular tenure. It might be 2 years, 5 years, whatever is the tenure. So that club has to receive the services from that player for a particular period. In such cases, what to do? Now, since you have a contract with such particular employee and the employee cannot move out of your club for that particular period, then you can recognize the amount paid to get the contract with that employee. There's certain amount paid to get the rights. So that amount can be recognized as an asset because you have control over it. So this is another example of the cases where such contracts are recognized as an asset. Another example, we ourselves have converted so many companies where you won't imagine certain transactions which out of nowhere came into the difference regime, or out of nowhere came into the Ind AS regime. One more example. Suppose I am a construction company. What did I do? I am a construction company. I constructed a particular asset for the particular employees. I constructed a club. As a consideration for my club, the government did not pay me anything. Instead of that, the government gave me rights to collect the membership fees from the members entering the club. Now tell me, I did not get anything immediately, but I got rights on which only I have control over that rights. The government cannot later on say that, okay, no, from today I will collect the membership. So that is why I have control over my right to receive the membership fees. Even in that case, that right is also an asset and which has to be recognized as an asset into the books of the company. Another example is, there are varied examples. So we'll cover that in detail manner later on also, but these are the cases where specifically there are many companies which enter into such barter transactions, and you'll have to keenly look into such barter transactions to understand whether these are satisfying the criteria of an asset or not. Now, these assets can be held for production, can be held for rental, or can be held for administrative purposes. It is not like my building or my administrative building is not giving me direct future economic benefits, but it is my linked asset to my main main activity of the business. That is why it could be any of these criteria, or it could be an asset without a physical substance. So these criteria of assets are the property, plant and equipment, and this criteria of assets are the intangible assets. So assets which are identifiable assets but lack physical substance, those are the intangible assets. For example, a software is a very simple example, and which every company has. So these are your intangible assets. We'll cover more difficult examples also. So these are your intangible assets. Now main change or main clarification is, previously various times the pre-operative expenses or the startup cost are capitalized into the books of the companies as pre-operative expenses, miscellaneous expenses as an asset of the company. But even under AS 26, these were not allowed to be capitalized as an asset in the books of the company. And under Ind AS, these are specifically excluded from the capitalization. So this is not a gap difference, but these has to be looked in, because even in the current practices, these are capitalized as an assets under the books of the companies. So as we discussed, this is the property, plant and equipment, and this is the intangible assets. So only thing which lacks physical substance we'll have to see as a intangible assets. But what do you mean by identifiable? Now what identifiable is, which arises out of a contractual or legal right and is separable from the company. So only if an asset arises from a contractual or legal right and it is separable, then only you can say that a particular asset is an identifiable asset. Now, for example, as a customer or as a company, I have a brand name, or I am a Kaka Halwai. I have a huge brand name. Does that mean I can recognize my own brand name into my own financial statements? Obviously, no. The main reason is, can you separate that brand name from your own business? You cannot separate your own brand name. Otherwise, there is no business. If Kaka Halwai is not working under Kaka Halwai, it doesn't have business what it existingly has. Unless it is a purchased goodwill, you cannot recognize the goodwill into your financial statements. Second example, you have a customer list. By conducting the business itself over a tenure basis or over a day-to-day basis, you developed a huge customer records. We have great examples like Facebook. We have great examples which apps work for the purpose of generating the customer list. Now, whether these are intangible assets or not, these are intangible assets because you can separate that out of your business. You can sell the customer price list to another company for their own benefits. So many transactions occur where the app or any business sell their customer list to Facebook or such any other entities. That is why customer list is an asset to the company. Then what is the second criteria? The second criteria is, how will you identify whether, how will you define whether a particular asset is controlled by the entity or not? If an asset is controlled by the entity, that particular entity should have the right to get the future economic benefits. And that entity should restrict others to get the benefits out of that assets. We have classic examples of, for example, a road. If a particular entity builds a road specifically to lead that road to its factory, Now, even if the entity is getting benefits out of that constructed road, can a particular entity deny access to other people from using that asset, from using that road? Obviously, no. Since the particular entity cannot deny access to general public from accessing that road, the company or the asset is not controlled by the entity and the asset cannot be capitalized into the books of that entity. So it is very important to define key. It is very easy to identify whether the particular entity is getting the future economic benefits, but it is very difficult to identify whether the entity can restrict the access to another people or not. If the entity can, only then it is controlling that asset. So this criteria is very important, and many people miss on to recognizing or giving impact of this criteria itself. So restricting access to get the benefit out of that particular asset. So only if these criteria is fulfilled, then only you can, or then only a particular item can be recognized as an asset into the books of the financial statements. One more example we will study is a particular entity is into the global positioning business. For the purpose of understanding that GPS, or for the purpose of conducting that GPS, the entity developed maps for its own understanding. And those were such maps that, or those were used through such technology that nobody else could use or access that maps. So since nobody could use or access that maps and it was developed for its own understanding, it is very difficult to identify whether this asset is separable or not. It is a questionable case. So only if this asset is separable and anybody else can use that asset easily and it is not specific to that particular entity, only then you will recognize that cost also into your books of accounts. If you have any queries, please note it down and we will discuss it ahead. So this was about, these criteria were about what is a property, plant and equipment and what is a intangible asset. Please note this word rental. We will discuss it ahead also. So please remember this, we will discuss it. Now, you are understanding investment property. There is a specific standard for investment property, but you all would be having a question in mind, what exactly is investment property, or what all items have to be classified as an investment property? So Ind AS 40 has given a particular criteria or has given a set of guidelines. Only if a particular asset is fitting into those guidelines, it will be classified as an investment property. So the first criteria is the property has to be land or building. No other item can be classified as an investment property. It has to be a land or building. Second is, it has to be held for rentals. That is, you should have given that property for rentals, or you should have held that property for the purpose of capital appreciation. And it should not be used for the purpose of production of goods or giving the services to the services or for any other administration purposes. And it should not also be held for the purpose of sale in the ordinary course of business. So ignore the not for the time being. Just let's discuss what has to be included. So it has to be a land or building. And second is, it has to be held for rental. So if you want to see if your company is giving any properties on rental, it might be smallest as flats or something. The company has invested into flats and for a time being they have given it for rentals. So that is one which has to be classified as an investment property. And there is no materiality criteria. You cannot say that it is just a 1 crore flat and my company is 1,000 crores. You have to classify that as an investment property. And second is held for capital appreciation. You're not using it into your business. You're not intending also to use it into your business. You've just held that property for the purpose of capital appreciation and later on you want to sell it and receive certain benefits out of it. So that also has to be classified as an investment property. Now, how will you decide what is the intent of the organization? At the time of purchase of such huge properties, they obviously have certain board resolutions. For what purpose is this property held? By having certain documentary proof only you can decide whether for what purpose is the property held. Now, one more classic criteria is if there is an unintended use. That is, as of now, the company is like, I might use it, I might sell it, I don't know what might I do out of it. So if there is an unintended use of the property, it has to be mandatorily classified as an investment property. So if your company is giving you reasoning that abhi pata nahi hai kya karenge, it might be into whatever criteria. So again, it is an unintended use of the property, and you will have to classify it as an investment property. So this is very important: rentals, capital appreciation, or an unintended use. So if a particular asset is, I mean, if it is has to be for an unintended use, then you classify it as an investment property. Now, since these criterias are for the, I mean, the positive criterias, obviously the negative criterias are it should not be used in the production or service of the goods or I mean, providing the services, and it should not be held for sale in the ordinary course of business. For example, I'm DLF. I am holding flats for the purpose of sale. It is my inventory, and I cannot recognize that flats as an investment property. And this is a mandatory criteria. You don't have any option whether a particular item has to be disclosed or has not to be disclosed as an investment property. So moving ahead, there are certain examples which we will discuss, which you first think whether these are investment properties or not, and I will give you the subsequent answers. Land held for long-term capital appreciation. As we discussed, it is an investment property. Building occupied for administrative purpose, whether it is an investment property or not. Since it is administrative purpose and you're not using into the business, what will you do? It is a property, plant and equipment. Administrative purpose is an aligned activity. So that also has to be your main property, plant and equipment. Building held for finance lease and leased out under operating lease. What should you do? Investment property or property, plant and equipment? It is held under finance lease and it is leased out under operating lease. So you're recognizing that asset into your company since it is a finance lease and you're leasing it out. It is a very simple question just framed in a difficult manner. You are holding an asset for the purpose of giving it on rentals. So that is an investment property. So don't get confused by finance lease and operating lease. Then tower cranes held for the purpose of rental purposes of a construction company. There are various construction companies who do not own their own plant and machinery. They get it on rentals. So if a particular company is giving such tower cranes on rentals, what to do? It is held for the purpose of giving on rental. Investment property or property, plant and equipment? It is a tower crane. That is, it is a plant and machinery. It is not a land and building. So by default, any plant and machinery doesn't fit into this criteria and will never become an investment property. So that is why this was, I had asked you to hold on to this rental purposes. So PP IAS 16 or Ind AS 16 covers only those assets which are not land and building and given for rental. So if I give my vehicles on rent, if I give my plant and machinery on rent, if I give my any of the furniture items on rent, even if they're given on rent, it has to be classified under Ind AS 16, property, plant and equipment, and will never fall under Ind AS 40, that is investment property. Then land held for undetermined future use. You don't know as of now what is the future use of that land. So as we discussed, unintended use or undetermined use has to be mandatorily classified as investment property. Property under construction to be leased out under operating lease. Now, even if it is under construction, still this property has to be classified as investment property. So don't wait until it will finally get constructed and then you will classify it as investment property. Still, it will be as an investment property itself. Building occupied by employees. This is a tricky case. Building occupied by employees, whether it will be investment property or a property, plant and equipment. It will be property, plant and equipment itself because it is for the main, I mean, the company can give its building for the employees. So it is for its main purposes itself and it has to be classified as an investment property. Property constructed for sale in the ordinary course of business. As I gave the example of DLF, it is an inventory and has to be classified as per Ind AS 2, that is inventory standard. So these are the criteria to define whether a particular asset is an investment property or not. Moving ahead. To the next slide. So what if a property is of a dual purpose? I have 4 floors in a property. 2 floors I'm using it for my own purposes and 2 floors I have rented out. In that case, what to do? You will have to decide whether it is capable of being separated or not. Can you give that entire property or can you sell that 2 floors of your building independent of your own 2 floors? If it is yes, if the criteria is yes, if it is capable of being separated, then you will separate the amounts. You will whatever is apportioned to property, plant and equipment, what you are using for your own administrative purposes will be property, plant and equipment, and whatever is given on rentals, that is the investment property. But what if it is not capable of being separated? A classic example, I am Imagica. I have given my certain portions to certain restaurants. I have given this 500 square feet to McDonald's. Should I classify that 500 square feet as an investment property? Can I sell only that 500 square feet to another entity? Obviously, no, it won't be feasible for my kind of business. Since it is not feasible, the division is not capable of being separated. Then what to do? In that case, you will decide what is the significant portion. If your significant portion is investment, or what is insignificant portion? If your insignificant portion is investment property, then you classify the entire asset as a property, plant and equipment. If your insignificant portion is investment property, plant and equipment, then you'll classify the entire property as an investment property. So here you will see the insignificant rule. Whatever is insignificant, ignore it and classify the entire asset as a PPE or as a investment property. So this has to be done for a dual purpose property. So till here we understood what has to be a property, plant and equipment, what has to be an intangible asset, and what has to be an investment property. So this was just a classification criteria which asset falls into the which criteria. Then we have the measurement criteria. Measurement criteria is similar for all the 3 assets up to 99%, I would say. Few minimal differences are there. So the measurement criteria is there to define how to measure that particular asset. Now, what it is very simple. This was there under your previous standard also. We'll just clarify, and there are few differentiating points over here. As we know, any particular asset has to be measured under cost. Many people had a disbelief or had a myth that under Ind AS or under IFRS, everything is at fair value. So it is not that way. There are certain standards which require fair valuation, but not for such kind of assets. Even property, plant and equipment, even intangibles has to be recognized as cost. Cost plus directly attributable expenses. So what does directly attributable expenses mean? Expenses which were incurred to bring an asset to a location and condition which is necessary for its intended use. So whatever expenses were incurred to bring that asset, to bring into that condition for which the asset was designed to be used, all such expenses have to be capitalized. So these includes all simpler examples such as your the transportation cost, your loading unloading costs, then your duties if those are not refundable. These are simpler examples. But I'll give you another example. What if you'll have to remove a previous asset? I have an existing factory. Already there is a plant and machinery on that location. I have to dismantle that plant and machinery and set up my plant and machinery. In that case, what will you do of that dismantling cost? Is it linked to your new asset? Some would say no, it is not linked to my new asset. And that cost is not giving me any benefit. That is just a discarding cost or a cost incurred for the disposal. Other way of argument can be, unless I remove that particular plant and machinery, I cannot set up this new plant and machinery on that location. So what to do? In Ind AS 16 also has a clear criteria on this. Even such dismantling cost or such relocation cost also has to be capitalized into the cost of the property, plant and equipment. Then there is another important criteria, another important cost, which is a dismantling and restoration cost. We'll discuss that in a detailed manner. For example, today I'm a windmill power generation company. I have set up multiple windmills into the various locations. Now wherever the windmills or wherever I've set up these windmills, I have a clause in my agreement that whenever the lease term will end, 30 years, 20 years, 25 years, you don't buy that area, obviously. I mean, if you have your own land, that's a different question. But if you have rented or leased out that particular land from certain governmental authority, you have a clause in that agreement that at the end of the lease period, at the end of the term, you will have to dismantle and restore that land as it is. So you might have dig certain portion of the land, you might have installed certain equipments under the land. You have to restore that land as it is and bring it into the location how it was given to you. Now, this cost has to be incurred after 25 years, agreed. But on what account are you incurring this cost? Because you have installed that windmills into that particular land, that is why you are incurring this cost. So since this asset or since this cost is directly linked to your asset, it is a directly attributable cost. And even if it has to be incurred after 25 years, still this cost has to be capitalized into the property, plant and equipment. Now you would say at what amount? For example, after 25 years, I would incur certain 25 crores of cost that I'll incur after 25 years. Now here comes a provision which is linked with another standard, that is Ind AS 37. So Ind AS 37, that is provisions, contingent liabilities and contingent assets, provide the measurement criteria for such kind of costs. These costs has to be discounted to present value. So 25 crores I'm going to incur after 5 years or 25 years, I'm sorry. So since I'm incurring that cost after 25 years, I have to discount it to the present value. And the present value of that amount, for example, it is say 15 crores. That 15 crores has to be added to the property, plant and equipment. So if my original cost is 100 crores, plus that 15 crores, 115 crores has to be the cost of property, plant and equipment. And this cost has to be depreciated over the over your tenure, over the useful life of the asset. Now another question is, at what rate should I discount? Should I take my own weighted average cost of capital? Should I take my cost of borrowing if I have taken certain loan for purchasing that asset? At what rate should I discount? These are the practical issues which arises. So by provision, you might know that decommissioning cost has to be capitalized in the cost of property, plant and equipment. But at what rate? Ind AS 37 provides that such provisions has to be discounted at the risk-free rate of return. So you will use the risk-free rate of return for the designed tenure for 25 years, and you will discount it using that rate of return and add it to the cost of the property, plant and equipment. So this is another difference between the old AS10. So old AS10 did not have any specific criteria for decommissioning and restoration cost. There were certain guidance notes, for example, guidance note on accounting for oil and natural gas companies. Such guidance note provided criteria or provided the policies or the guidance for capitalizing such cost, but it was never given into the standard. So only such design companies, oil and natural gas companies, used to follow such accounting policies. Under the revised AS10 and under the Ind AS 16, such decommissioning and restoration cost has to be capitalized into the cost of the asset and depreciated over the useful life. Under Ind AS 37, you would study that how that provision would come into the, now today we had the 25 crores of provision, which will incur after 25 years. You have discounted it and brought it to 15 crores. That 15 crores was added to the property, plant and equipment. Now, how will this 15 crores amount reach to 25 crores at the end of 25 years? What will you do over the period? If you don't do any accounting, at the end of 25 years, you will realize that in your books, the provision is still appearing at 15 crores, but you will have to incur 25 crores. Then what to do? Will you debit 10 crores to that year of that financial year? What will you do? So you will have to think from every perspective. This decommissioning is not just a single accounting entry. This 15 crores has to be brought to 25 crores by debiting your P&L by the finance cost. So every year you will debit 7% of 15 crores to your profit and loss account, and at the end of 25 years, this amount would reach from 15 crores to 25 crores. So this is the entire accounting for the decommissioning and the restoration liability. Your account heads what are impacted are the property, plant and equipment, decommissioning and restoration cost, provision for decommissioning and restoration cost, finance cost, which is debited to your P&L over the period of 25 years. Now, what should not form the part of, what should not be cost of your property, plant and equipment? Your training cost, your feasibility study. You have just not decided which land to invest into. You're just conducting a feasibility study. So as of that date, you don't know whether you will receive a future economic benefit or not. That is why such cost or admin and overheads cost, this is a bigger, you might call it as a difference. So under previous standard or under the previous gap, many people used to capitalize the admin and overhead cost by allocation. So they used to allocate certain percentage of the admin cost and capitalize into the cost of PP. This is clearly not allowed to be capitalized under the cost of your property, plant and equipment. So clear, did we understand what has to be capitalized and what has not to be capitalized? Then is your subsequent expenditure. So subsequent expenditure has to be capitalized only if it meets the asset criteria. If it does not meet the asset criteria, it has to be transferred to the repairs and maintenance account, and it will not be capitalized into your original assets. We will also link it to the component accounting. We'll also link this subsequent expenditure to component accounting. We'll move on to the next slide. Now, any particular asset, what has to be the mode of measurement depends upon what is the mode of acquisition of that asset. So don't look into the pure normal transaction of your buying an asset. Look, give a wider view to it. There are various modes of acquiring a particular asset. For example, if it is a normal acquisition, then purchase plus directly attributable cost. What if you're receiving an asset out of business combination? What to do in that cases? We will discuss this in detail in Ind AS 103, but still to get a holistic view. In that case, such assets are recognized at fair value as on the date of acquisition. Internally generated assets, which are allowed to be capitalized. Directly attributable costs are, you recognize that asset using the directly attributable cost. Then the exchange of assets. If there is an exchange of assets, in case of exchange of assets, the asset has to be recognized at the fair value of the asset acquired or given up, whichever is clearly identifiable. So the earlier example I gave, the company had constructed a building and in return got the membership right to collect the membership fees. In that case, you cannot recognize the intangible asset at only the cost incurred by the company. Today I have incurred cost of 20 crores to construct that particular building, but I cannot recognize that particular asset at 20 crores only. You will have to recognize the asset at the fair value of the asset given up or asset received, whichever is clearly identifiable. What does it mean? If you would have sold that particular building, I'm already a construction company. I already construct buildings for various companies. So if I would have constructed and sold that particular building, I would have added a margin of 10%. So in that case also, you will capitalize the asset at cost plus 10% margin and recognize the value of the asset. So this applies to the property, plant and equipment as well as the intangible asset in case of exchange of assets. It has to be recognized at fair value. What if you have received the asset through a government grant? It has to be recognized at cost or fair value. Fair value has been removed through an amendment to the government grant standard. Previously, it was cost or fair value at the option of the company. With the recent amendment to bring in line the standard with the IAS standard, the IFRS standards, the fair value option is also removed by the government. So these are the various modes of acquisitions and how to account for such assets into your books of accounts. So this was detailed guidance about the measurement of an asset, the decommissioning cost for an asset as we discussed in a detailed manner, and the exchange of assets. So exchange of assets and the decommissioning cost we have discussed in a detailed manner. If you have any queries on the measurement part also, you can list it down. We will discuss it at the end of the session. Moving ahead. Subsequent cost. How to account the subsequent cost? If it is meeting the criteria of an asset, as we discussed through the definition, if it is having a future economic benefit, you have the control and it is to be used for more than 1 year, then you capitalize as an expense, otherwise charge it to the P&L. But here comes the concept of component accounting also. For example, I have a plant and machinery and my the main part of my machinery, that is a main tool to my machinery, has been capitalized as a separate component. In that case, for example, if my total cost of my machinery is 10 crores and I have capitalized a cost of 3 crores, which is an important part of the machinery, as a separate component. So this 3 crores is my separate part capitalized. Whenever I'll replace that component with a new component, I will de-recognize that original asset and then I will capitalize a new asset. The life, for example, the life of that 3 crores component was say 5 years, but I had to replace that part within 4 years itself. So whatever is the WDV of that component has to be de-recognized. Only then you can capitalize that new component. So just, I mean, on a day-to-day basis, or majority of companies make this mistake. They do not de-recognize that original component and just keep on capitalizing the new components. So you will have to identify whether you have followed a component accounting, or component accounting is mandatory obviously, but whether it is a separate component, whether you should de-recognize that particular asset and then capitalize the new asset. We'll discuss certain examples. So we'll discuss certain examples. For example, for my industry or for my type of asset, the inspection and overhauling cost is a mandatory cost. I'm into the shipping industry. I'm into the airlines industry. After every 3 years, my assets has to be inspected by a particular authority. If they find it that that asset is in a feasible condition to be run, only then I can run that particular asset after the designated period. So whatever cost I'm incurring for the purpose of inspection and overhauling is a separate component and has to be capitalized separately. So if I incur 1 crore of cost after every 3 years, I will capitalize that 1 crore cost as a separate component and I'll amortize or I'll depreciate that cost over a period of 3 years. My original asset might be a 30 crore asset, which might have a life of 30 years. So that will be amortized over a period of 30 years, and my individual component of the inspection and overhauling cost will be capitalized as a separate component and amortized over a period of 3 years. Similarly applies to the spare parts. Again, in spare parts, you will have to define whether that asset is meeting the criteria of an asset and then only capitalize as a separate asset and amortize it according to the life of that particular spare part. Moving ahead to the subsequent measurement of that particular assets. So as under Indian GAAP, similar over here, you have two models. You have the cost model and you have the revaluation model. You can define under the property, plant and equipment for the entire class of asset whether you will have to follow the revaluation model or the cost model. You cannot say that out of my 10 lands, I will use revaluation model only for 3 lands and remaining 7 I won't use. So it has to be for an entire class of assets. If you decide for land, it has to be for all the lands. But that does not also mean that if you're saying that you're applying revaluation model, it has to be for all the property, plant and equipments. You can use land under revaluation model, plant and machinery under cost model, building under revaluation model, your furniture and equipments under the cost model. That is allowed. It is as per the class of the asset. Please remember that. So you can decide which model of the subsequent measurement you are following for that particular asset. If you're following the cost model, it has to be cost, less depreciation as per the useful life of the asset, less any impairment. Impairment has to be tested only if there are indications of impairment. Otherwise, you don't have to test your assets for impairment on yearly basis. Only if there are indications of impairment, then only you will test that asset for the impairment and follow the criteria given under Ind AS 36, that is a separate standard on the impairment. If you are following the revaluation model, you will use a revalued amount and depreciate that revalued amount over the period of the useful life. Now, for the purpose of intangible assets, you can follow the revaluation model only if there is an active market for that particular intangible asset. If there is no active market for that intangible asset, you cannot follow the revaluation model for that intangible asset. And it is very difficult to identify whether there is an active market for an intangible asset or not and prove there is an active market. because intangible assets are such assets which you do not, unless these assets are in the nature of software or something, other assets like patents, copyrights, your own customer price list, it is very difficult to identify whether there is an active market for that assets or not. One more thing which is not linked to this standard but is linked to Ind AS 103, that is business combinations. Just to give a slight highlight. Now, under your previous gap, if you were doing a business combination accounting or a merger or amalgamation accounting, you used to capitalize only those assets which were appearing in the books of your transferor into the books of the transferee. I am a company A, I am acquiring company B. Whatever assets and liabilities are appearing in the books of company B, only that I can capitalize in my own books. But under Ind AS 38, that is intangible assets, there is additional criteria. Even if a particular asset was not appearing in the books of your in the books of that company, in the books of company B, in my example, but that asset is meeting all the criteria of intangible assets, then you can capitalize that assets into your own books in your business combination accounting. Continuing my example, if the company B had not capitalized the customer price list into its own books because they might not have considered it as a future economic benefits for that price list, but I'm Facebook, I'm acquiring that particular company. For me, that customer price list is the main asset on account of which I'm acquiring that company. I can capitalize that customer price list as a separate asset at the time of business combination accounting, even if that asset was not appearing in the books of the transferor company. So this is linkage of Ind AS 38 and Ind AS 103. What will happen on account of such separate accounting? Your amount of goodwill will be reduced. If the company has a net worth or a net assets of say 100 crores, I have given say 1000 crores for acquiring that company. I have paid additional for what? My the way of measuring that customer price list was say it got a value of 500 crores. Your goodwill amount reduces by that proportion and your asset of customer price list come into your books of accounts. And that is again a mandatory thing. There is no option whether you have to capitalize a customer price list or not. If there is a business combination and there is a particular asset which can be capitalized separately, you have to capitalize that particular asset separately. Okay. Moving ahead to depreciation and amortization on the property, plant and equipment and intangible assets as well as the investment property. Investment property has to be measured at cost that we have discussed previously. Depreciation is similar to what we have discussed previously. It has to be allocated or it has to be apportioned on the useful life of the asset. Component accounting comes into the picture, what we have discussed earlier. So on the basis of the useful life of that component, you will have to depreciate that asset. There is again lives given under the Schedule 2 of the Companies Act. You will have to take a reference of that life given under the Schedule 2 and you will have to amortize that particular asset over that useful life. Now, what is another difference? You have two methods of depreciation, straight line method of depreciation and WDV method of depreciation. Change in the method of depreciation, for example, from say SLM to WDV, under the previous gap was classified as a change in accounting policy and had to be given a retrospective impact. But in the current standard, under Ind AS 16, linked with Ind AS 8, this change in estimate of change in depreciation from WDV to SLM or SLM to WDV or whatever is a change in estimate and has to be given impact prospectively. There's a logic to this also. What does the standard say is WDV or SLM is a base of estimate. How do you estimate your asset will be used? If I'm having a plant and machinery, why do I use a WDV method? Because I expect or I estimate that in the initial years it will give me more benefits and in the subsequent years it will give me a lesser benefits. If you're changing your method from WDV to SLM, it is a base of estimate. Now you're estimating that it will give you benefits over a straight line period. So since it is a change in estimate, it should not impact your retrospective financial statements and has to be given impacts only prospectively. No restatement, nothing will happen on account of change in the method of depreciation. You will have to review the method of depreciation and useful life. Now your method of depreciation and the useful life is as good as, and both are estimates. Both are at par for you. So you will have to estimate, or you will have to revisit your estimates at the end of each reporting date. At least once in a financial year, you will have to revisit whether your estimate of useful life and the estimate of the method of depreciation is appropriate or not. Now, amortization. This was all about how do you depreciate the property, plant and equipment and the investment properties. Now, what about the amortization? Under intangible assets. Previously, under AS 26, you had normal criteria of you should amortize it over the strict period of 10 years, or in case of your amalgamation standard, you used to amortize the goodwill over a period of 5 years. But over here, you have the amortization criteria based on the useful life of that particular asset. And one more important criteria you will have is your intangible asset can have an indefinite useful life. What does that mean? You can classify a particular intangible asset that this asset will give me a benefit over a period of indefinite period. That is why I decide the useful life of the intangible asset as an indefinite useful life. And if a particular asset is defined as an indefinite useful life asset, you do not amortize that asset. So proving this it is having an indefinite useful life is difficult, but it has to be amortized. It will not be amortized in case it has an indefinite useful life. A classic example which falls into this criteria is goodwill on acquisition. For example, you are paying certain additional amount for the purpose of goodwill on acquisition. Under the previous GAAP, you used to amortize this particular goodwill over a period of 5 years. But under Ind AS, you are not allowed to amortize the goodwill. Mandatorily, you don't have to amortize the goodwill. It will stay into your balance sheet for an indefinite period. Only you will measure that goodwill for impairment at every reporting date. So as we previously discussed, property, plant and equipment, investment property has to be tested for impairment only if indications arise. But for the goodwill, you will have to test the goodwill for impairment at every financial year. So that is the difference between the impairment criteria also. So goodwill is not amortized in the Ind AS and it has to be tested for impairment. So goodwill on amalgamations, goodwill on business combinations, goodwill on consolidation, any goodwill should not be amortized into the books of accounts. Now, as we discussed, how do you define the useful life? It is very simple. What is the expected life of the asset? How many life cycles are you expecting? Is the asset of obsolescence in nature? What is the industry applicable for that particular asset? All these criteria you will check to define the useful life of that particular asset. Now, another is how do you define whether the life of the asset is indefinite or not? If you see that there is no foreseeable limited period over which the benefits are expected, you cannot limit that period. Only in that cases you define the useful life as an indefinite useful life. The important thing is indefinite useful life does not mean an infinite life. There is a difference. Indefinite is only when you cannot estimate or you cannot foresee over what period the asset would give you the economic benefits. Moving ahead. Now we saw that there are various differences between the Ind AS and the Indian GAAP. We also saw it how it is different from the older AS 10 and the revised AS 10. Now what to do in case of the first time adoption? You are applying the Ind AS first time to your companies. There are listed differences. What to do in that case? Do you have any exemptions as we discussed as per Ind AS 101? Now there are exemptions for the purpose of property, plant and equipment, intangible assets and investment property. The exemptions are, and these are the exemptions, it means that these are optional in nature. If the company wants, it can apply Ind AS 16, 38 and 40 on a retrospective basis. It can change all the values, give the impact as on the date of transition and move ahead to Ind AS. But if the company wants, at the option of the company can use these exemptions. So what is the exemption? You can carry your property, plant and equipment, intangible asset and investment property at a deemed cost. What does this deemed cost mean? Deemed cost means either of these three options. First option is your deemed cost can be fair value of the asset. So fair value means you can fair value as on the date of transition and give the impact of the fair valuation as on the date of transition and carry the assets at fair value. So fair value is different and revaluation model is different. So if you're using the fair value option as on the date of transition, that does not mean you will have to use the revaluation model forever. No, not that way. So for example, if my land, the cost of the land is 10 crores. As on the date of transition, I fair valued land and building and fair valued to 50 crores. So the 40 crores gain will be transferred as on the date of transition. And therein after, I can still follow the cost model and depreciate this 50 crores over the tenure or over the useful life of that asset. I don't have to use again revaluation. So once I use this fair value model or fair value option, does not mean that every reporting year I will have to use the revaluation model only. It is not linked. Secondly, an event-based valuation. For example, previously I was thinking to, or I was into the this thing to conduct IPO. I had filed my DRHP. At that point in time, I had conducted the valuation of my properties. So can I use that valuation? So this is an event-based valuation, which can become the deemed cost for the purpose of your property, plant and equipment, intangible assets, and investment properties. Or the third option, which is the companies which have used, majority of the companies which have used this option is continuing with the Indian GAAP amounts as it is. So no changes made, only continuing with the whatever amount is appearing in your Indian GAAP financial statements will be continued as it is into your Ind AS financial statements, which will become the deemed cost. So whatever differences were there previously, whatever you would have capitalized, that all is subsumed into this deemed cost exemption. Whatever is your Indian GAAP value becomes your Ind AS value. There is only one exception to this is if you have a decommissioning and restoration obligation, you will have to account for that restoration obligation and then move ahead. If you don't have the decommissioning and restoration obligations, then you move your Indian GAAP value as it is to the Ind AS value. No changes are to be made. So these are the three exemptions which are for the purpose of transiting from Ind AS to from Indian GAAP to the Ind AS. To discuss, decide how many differences are there between Ind AS and Indian GAAP, we will discuss all the key differences in a brief manner so that you understand why these exemptions are so much relevant. Between Ind AS 16 and the AS 10, one more difference is, the difference which is linked with the borrowing cost standard is, I'll discuss that exemption also. For example, if you have purchased an asset, today I have purchased the asset, but my terms with the creditors are, I will pay you the payment after 2 years. Now these are deferred terms. Nobody gives a credit period of 2 years on a generic basis. You have the deferred credit period for your asset. In that case, for example, if my cost of asset is 100 crores, I have decided the terms with my creditor as I will pay this amount after 2 years. So what to do in that case? Should you capitalize the asset as 100 crores or at a different amount? In that cases, you will have to discount that 100 crores to present value by the 2 years difference. For example, that value comes up to 80 crores and you will capitalize that amount at 80 crores. So your asset or your property, plant and equipment will appear at 80 crores and not at 100 crores because you had a deferred payment terms. You had an extended credit period as compared to a normal credit period. So in that case, you will discount the asset and then capitalize the asset. Second difference, which is linked to the borrowing cost standard is, for example, you would have capitalized the borrowing cost into the cost of your asset. You would have capitalized the interest component because it met the particular criteria of the borrowing cost. Under Ind AS, you will have to capitalize the borrowing cost at an effective rate of interest. What is effective rate? That we will discuss later on in the financial instruments and many other standards. But effective interest cost under the normal rate of interest, which is charged by the bank, and interest cost under the effective rate of interest is different. So your borrowing cost, which would have capitalized in the property, plant and equipment under Indian GAAP, vis-a-vis under Ind AS would come up to be different. So in that cases, this will also be a point of difference. Then there is another difference of Forex. Do you remember under AS 11 there is an option under para 46A which says that you can capitalize the forex cost into your cost of the asset if it meets the particular criteria. There might be many companies who would have capitalized the forex gain or loss into the cost of property, plant and equipment. Under Ind AS, there is no such option given to the company. You might have heard of certain reserve made by the company as foreign currency revaluation reserve. That was when the companies used to capitalize such such forex differences into their property, plant and equipment. So even that forex gain or loss is not allowed to be capitalized under Ind AS. So this is another difference. Second and third is what we discussed, change of depreciation. If you would have given a retrospective impact on account of change of depreciation from SLM to WDV, WDV to SLM, that is again a difference. Here it is prospective, there it was retrospective. Administration and general overheads, those you might have capitalized certain admin and general overheads, but under Ind AS it is not allowed. Then is the restoration and dismantling obligation. You might already have a restoration and dismantling obligation. Till date, you did not make any provision. Again, there is a difference. So that is why you have to use, or companies tend to use either of these optional exemptions, because it is very difficult to change your property, plant and equipment from the day one of capitalization and bring it to the value as on the date of transition. Further, what is the differences between intangible assets and your previous standard of AS 26? Subsequent measurement under AS 26 and intangible assets, your depreciation criteria are different or amortization criteria are different. Useful life, infinite useful life was never allowed under Ind AS or Indian GAAP. Intangible assets acquired under a business combination, as we discussed, customer price list, fair valuation was never there under the Indian GAAP. Goodwill on acquisition or consolidation, this was always amortized under the Indian GAAP and it is not allowed to be amortized under the Ind AS. So using these exemptions, you can carry your assets under either of this option and continue with the deemed cost exemption. Now, one more key change or one more key resultant effect of this deemed cost exemption is what? What does this deemed cost exemption say is your WDV as on the date of transition becomes the cost of your asset as on the date of transition. So what does this eventually mean? Your WDV, your gross block minus the accumulated depreciation becomes your cost. So in your FA schedule, what you disclose in the financial statements, as on the date of transition, you have the net WDV as your gross block and your accumulated depreciation as on the date of transition is nil. You have zero accumulated depreciation as on the date of transition. This is the exact interpretation of this word deemed cost. In spite of this, you might see majority of companies have used this deemed cost definition as it is, and they have shown that their WDV or accumulated depreciation as on the date of transition as nil. But there are also various companies which have not used this deemed cost as it is, and still they have shown the WDV as on the opening date as it is. What difference does it make? Every time, whenever you sell that asset, you will have to differentiate between what was the accumulated depreciation as on the date of transition and what was the accumulated depreciation after the date of transition. Why? Only that part which was accumulated after the date of transition will be removed from accumulated depreciation, and rest entire part will be removed from your gross block. So forever you will have to maintain your FAR as if what was the WDV as on transition date and what is after the transition date if you are using this deemed cost exemption. So this is a direct implication of this deemed cost exemption where you are using the values as it is under the Indian GAAP. What are the disclosures differences required under these standards? So the disclosure differences were the same, or disclosure requirements are the same under the Indian GAAP and Ind AS. That is, you give a schedule on the property, plant and equipment and intangible assets. But for the investment properties, you have a separate requirement. You have to show the opening value, add additions, less deletions, gross block and the accumulated depreciation. But you also have to give the fair value of the investment property as on the reporting date. This is a mandatory disclosure. So as on every reporting date, you will have to fair value your investment property as per Ind AS 113. That is a separate standard on the fair value requirements. Fair value that investment property and disclose that fair value in your balance sheet. You will also have to disclose what methods of fair valuation you have used. You will also have to discuss what all costs were incurred for the purpose of this, what all are the direct link costs. For example, you give your property on rent. When you give your property on rent, you also incur certain costs such as valuation of that property, designing an agreement for the purpose of the rental agreement. All these costs you will have to separately disclose what all are the costs linked to this investment property and disclose it under the note of investment property. Under your in your first Ind AS financial statements, you also give a separate note of what all optional exemptions you have used. If you are using this Ind AS 101 exemption, then you will have to disclose in your financial statements that you are using the Ind AS 101 exemption of deemed cost, and accordingly the values under the Indian GAAP are disclosed same under Ind AS, and you are carrying forward the same values. So you will also have to disclose this optional exemption taken under your Ind AS 101 note. So these was all about the Ind AS 16, 38 and 40 standard.